Hi, this is Haimo. Thanks for stopping by for another dose of bite-sized bits of knowledge where we give you meaningful information in a short amount of time. Today we're talking about general partnerships and all you need to know about general partnerships. So, it's very interesting that most people don't realize that just doing anything collaboratively with another person with the profit motive makes you in a general partnership under the common law. And that is a very dangerous proposition. That's because general partners have duties to each other that you probably didn't know you had. And there's also obligations imposed upon one another to the partnership that you also probably didn't know you had. So it's important to understand what you're getting into before you get yourself into trouble. And as we're going to discuss in another video, it just cannot overemphasize the need for a partnership agreement. So let's talk about general partnerships. First, formation. There's, just like sole proprietorships, there's no formation required. There's no state filing. As I said, it's just two people collaboratively working together for profit that, under the common law, creates a general partnership. Again, I highly recommend a partnership agreement. We'll get into that. The number of owners, obviously, is a minimum of 2. Raising capital, you can do it much more easily than a sole proprietorship because you can just add more partners. In terms of length of existence, well, it could dissolve on death or withdrawal of a partner unless the partnership agreement says otherwise. So that's an example of a default rule that really could be disruptive to your business if you find yourself having to dissolve because you didn't know the rules. In terms of operational requirements, there's very few. The partners are both pretty much overlapping with management, which we're going to get into next. Each partner really has an equal voice. And more importantly, each partner is an agent and manager or board member, if you would, of the partnership. So you can have multiple partners running around binding the partnership really without the other partner's consent. And that's very scary to a lawyer. That's very scary. So again, another reason to have a partnership agreement to get all that stuff tightened up pretty good. In terms of limitation of liability, partnerships are like sole proprietorships. There's virtually none. There's none. They have an unlimited personal liability exposure of each partner. What does that mean? That means that if the partnership has liabilities, debts, credit cards, leases, contracts, slips and falls, personal injury lawsuits, product liability lawsuits, it overlaps into each of the partners' assets. And so you can find these business creditors coming after your personal assets, which, again, as a lawyer who does what I do, it's very scary and it's totally unnecessary. Regarding taxation, it's taxed one time. Really, the partnership doesn't pay tax at all. It just reports the tax and it flows through to each of the partners' respective K1s. That's what it's called. It's a Form K1 where each partner reports its share of the profits and losses on its personal 1040 and pays taxes based on its personal taxes based on its personal rates, as opposed to a corporate tax schedule. In terms of interests, transferability, yes, you can absolutely transfer interest, but just like the sole proprietorship, it's really transferring the assets. You know, if you have a commercial property, for example, like you're transferring the property, you're transferring the contracts, the leases, the intellectual property, the customer information, like that. That's like your assets. Just, maybe you have a name, a trademark, that kind of stuff, but you're really not transferring equity in a company because no company exists. There's no formation of a legal entity, really. In terms of allocation of available cash, as you start to be profitable, you accumulate cash and you may want to distribute that cash to the partners. Well, default rule will kick in and you got to do it a certain way, whether you like it or not. But you have the power and the right to change all that stuff in your partnership agreement. And I can't encourage you enough to do that. Investors generally want things to be different than what the default rules are. They want to get paid back first. They want maybe a preferred return. They want protections. They want allocations of profits and losses to them first. They're very flexible. Dissolutions, meaning closing the business. It's very easy, just like a sole proprietorship. It's not as easy, but it's easy. General partnerships are best suited for multi-owner businesses desiring, personal liability, desiring limited personal liability, but in flexibility in management and distributions and tax. Generally, when you do a general partnership, it's more of a joint venture between other companies, so that, again, the shareholders, the general partner's personal assets are not vulnerable to the business. But even then, I still wouldn't recommend it. I still would not recommend it. There's just better alternatives that don't have unnecessary risk. So I would say the bottom line with general partnerships is that they're easy to form, they're dangerous to manage, unlimited personal liability, and they're just completely unnecessary. So I don't like them. Again, I want to remind you, we have a really informative, free Florida formation checklist. The link is in our description. And we also have a free business planning stress test. So please download those at your convenience. Thank you for stopping by, and stay tuned for more.